Hello, everybody, and welcome to the third webinar of the 2018 Investor and Corporate Partner Readiness webinar series organized by Navigate, an innovation program of the Northeast Clean Energy Council. My name is Catarina Madeira. I'm Director of Navigate, and I'm here today with an outstanding panel of investors and entrepreneurs to talk about impact investing and diversity as a key driver for economic growth. For those who are new to our webinar series, this series is part of NECEC and Navigate mission to support cleantech entrepreneurs and ecosystem stakeholders such as incubators and accelerators located across the Northeast by providing them not only with learning opportunities like this webinar and access to experts, but as well with connections to investors, corporates, and customers to help them start, grow, and scale their businesses. We started this series earlier in the year talking about investment-related topics, and later in December, we'll discuss corporate partnerships and focus on a couple of case studies involving not only corporates, but utilities as well. So please stay tuned as we'll be releasing more information soon about the next sessions. I should be able to, exactly. These webinars are in fact Navigate have the invaluable support of all these fantastic sponsors. The Massachusetts Clean Energy Center, the New York State Energy Research and Development Authority, or NYSERDA, the Rhode Island Commerce Corporation, the Rhode Island Foundation, National Grid, and the Roy A. Hunt Foundation, with whom we work very closely to design and provide tailored programs and highly vetted opportunities to the clean tech community. Our ultimate goal at NECEC is to drive innovation and accelerate the clean energy sector in the region, and it is an honor to us to have all these funders as such hands-on partners. Thank you so much to everyone. We are very pleased today to have this great panel of impact investors that invest across several sectors, not only clean tech, and entrepreneurs. We'll hear from Julian Zimmerman from Reinventure Capital, Leslie Arwell from Alante Capital, Sandy Morali from Solstice, in a discussion moderated by Scott Blair, a member of Morse Barnes-Brown Pedleton. But before passing the word to Scott, I'd like to kindly remind you to stay on mute to avoid any sound problem. And whenever you'd like to make questions, please use the Q&A feature. And at the end, please do send us your feedback. It will be very important for us to improve future sessions and for our funders and partners as well. And now, without further ado, it is my pleasure to end the webinar to Scott Blair. Scott, the floor is yours.
Great. Thank you, Katarina, and a virtual hello to everyone who is joining us from multiple spots around the globe today. Very happy to present this very important topic to everyone today, and looking forward to a thoughtful and engaging discussion about impact investing and diversity with our illustrious panelists here. As Katarina said, my name is Scott Blair. I'm a partner at the law firm of Morse Barnes-Brown Pedleton in Boston, where I focus my practice on representing emerging technology companies and entrepreneurs, and also have a very active practice representing venture capital and angel investors. And when Katarina first asked me if I would be interested in moderating this panel, I was thrilled by the opportunity, because I think these topics that we're talking about today are incredibly important and something that's really vital that there's kind of an open line of communication to discuss. I'll just say a couple of thoughts before I turn it over to some of the panelists to give an introduction to themselves and their respective companies, and before we get into the Q&A. But speaking of diversity first, I mean, venture capital, if you think about it, is literally funding the future. And the decisions that are made by venture capital investors really filter through to the broader community, and those of us that live and work in the entrepreneurial ecosystem, both as investors and advisors, such as myself, I think really have a responsibility to ensure that the right decisions are being made and that the industry is free from bias it's no secret that venture capital has one of the most homogeneous workforces in the world, notwithstanding the great venture capital investors that we have represented on today's panel. A study from a couple of years ago that looked at the top 70 or 75 venture firms, representing about $200 billion in assets, found that at the partner level for those firms, 77% were white and 91% were male, and only 2% were female and not white. And, it's still the case that if you're from a different race, religion, sexual orientation, age, or professional background from the industry norm of a, white, heterosexual, middle-class male, you're going to find it more difficult to get a job in venture capital. And this impacts the companies, I think, that ultimately get funded. So it's really an important issue that needs to be addressed. I think that there are some really positive developments in the area that maybe I'll touch upon in this panel discussion. But it's a really important area, and I'm looking forward to the conversation about that today. With respect to impact investing, if you go to any social impact conference, you'll probably hear that soon there will be no quote unquote impact investing. There will simply be investing, period. And I think with the rising group of millennial investors rushing into the field, the idea that impact investing might soon come to dominate investors' way of thinking is increasingly conceivable. There's a reliable report that came out that just last year in 2017, an estimated $140 billion was invested in impact investment strategies. And that's up more than tenfold since just 3 or 4 years prior in 2014, when there was around $10 billion invested in impact investing. So it's certainly an area of increasing focus, and looking forward to hearing from our venture capital panelists today about that a little bit more. So with those initial introductory remarks out of the way, I would love it if each of our panelists could, as an introduction, just introduce themselves to the group here today and talk a little bit about what their funds in the case of the venture capital panelists and their company in the case of our esteemed entrepreneur panelists, just tell a little bit more about those entities. And so first, I think, why don't we kick things off? And Julianne, if you want to maybe give an introduction to yourself and Reinventure Capital, that would be wonderful.
Thank you very much. Thank you, Katerina and Scott. Thank you to my esteemed fellow panelists, and thank you to all of you who are with us on this panel today. As Scott mentioned, my name is Julianne, Managing Director with Reinventure Capital. Katerina, could you advance? We are focused specifically on investing in companies led by people of color and women for both impact and economic reasons. And so I'm really delighted that we're talking about that today. So just to set the expectations or framework for that conversation, it's worth reviewing that, as Scott said, not only is the leadership in venture capital very homogeneous, but several studies have found that less than 1% of venture capital has gone to companies founded by African Americans. Next, please. And less than 6% has gone to women-led businesses, even though the economic indicators of those businesses are quite positive. Next slide, please. And even worse, as Scott alluded, the number of companies successfully able to raise $1 million or more, led by Black female founders, is approaching 0. 34 is a big jump up from the 11 that it was just a couple of years ago, but that's still effectively none. Next slide, please. So at Reinventure, we ask this question: Do you believe that those numbers are actually indicative of a well-functioning, rational market, appropriately pricing opportunity and talent? Or do you believe that there's a market dislocation there and that there is considerably more talent and considerably more opportunity that the market just doesn't perceive or value. Next slide, please. In our case, we see a tremendous amount of talent, a tremendous variety of opportunity, excuse me. And we think that for a variety of structural reasons, the mainstream market, mainstream investors simply
It's her network.
Hello,
could we go to the next?
Julian, I'm sorry for interrupting, but you cut for a minute. I'm not sure if it is a network problem, but if you could please repeat this slide, we would appreciate it. Thank you.
Oh, sure. I apologize. So what I was saying, Reinventure, see these numbers, and we ask the question whether you believe that those numbers are indicative of a well-functioning, rational market appropriately pricing talent and opportunity and risk, or whether you believe, as we do, that there's a significant dislocation there. The market simply fails to recognize a considerable amount of opportunity and a considerable distribution of talent. And we see that opportunity for ourselves, for our fund, not only as an opportunity terms. Can we advance?
Yes, I'm sorry, you cut again. Would you have the chance to dial in using your phone?
Sure. I apologize.
Well, we can work around it. Thank you.
To proceed, shall analysts.
Okay, do you want me, could you please cover this slide with Solstice?
Yes. So here we have Steph Spears, Sandia's colleague, who is, like Sandy, a representative of the opportunity we see. So Reinventure targets companies led by people of color and or women and or people of color, companies that are at or about break even and poised to grow profitably, because we're interested specifically in growing up economic engines. We look for companies in fragmented markets, ideally where they're taking advantage of shifting conditions that might be technology or demographics or use case, that might be they might be able to take market share or seize version market share, because established incumbents are less capable of seizing those opportunities. And as a result, they're poised to become number one or number two in their sector. And ideally, we prefer companies with a commitment to their own impact objectives and a commitment to hiring, promoting, and compensating equitably at all levels of their company as well. Next. Could we advance?
Yes. Another one?
So really, yeah, sorry. Could you go back to the pathway?
Yes.
Maybe since we're having so much difficulty, I'll just say that we focus where we focus because there are some resources available at earlier stages, pre-seed, seed, startup. We focus where we focus because we see that that is a really significant gap where a lot of founders unfortunately reach a pinch point that becomes grow or die. And it's our mission and our impact objective, and also our investment strategy to focus there for maximum benefit. And much trouble. Let's skip the other slides, and I'll just wind up by saying that we believe that this approach is better for founders and better for our LPs. And we believe, from my senior partner, Ed Duggar's former success at executing this very same investment approach, that it is absolutely possible to produce both tremendous impact and compelling competitive market returns. And I'll stop there and reconnect by phone. I apologize for the technical difficulties.
That's quite all right, Julianne. Thank you very much for those slides, and I think we were able to get the gist of your comments. So thank you again. So with that excellent introduction out of the way, why don't we go now to Leslie? Leslie, if you could just give a brief introduction to yourself and your fund, that would be wonderful.
Absolutely, and thank you so much for having us today, and for all the panelists also. This is a great group of people and excited to be here. So I am managing partner of Alante Capital. Could you just advance to the next slide? So we're a venture capital fund that's investing in the transformation of the apparel and textile industry, and really focusing on the sustainable transformation. So looking at both software and material science companies, as well as business to consumer platforms and solutions that can really change the way that the industry works. So it's really digging in, looking for solutions to actual problems. So I and my business partner, Carla Mora, started thinking about this strategy when I was at JP Morgan a couple of years ago, and was looking at venture capital funds that had these types of systems change approaches, where they looked at a particular industry, really dug down and tried to understand where there were major problems that were at this intersection of business and sustainability. So looking at issues around resource scarcity, looking at issues around waste, and really thinking about how this whole movement of conscious consumption has been changing. So we really saw that it was an underfunded space, and that started hearing a lot of commitments from large corporations that a lot of these issues, whether it was around usage of chemicals, new materials, thinking about plastics and polyester and different materials, and waste and the end of life, and all of the things that their customers were starting to push them on, really mattered. And they couldn't do the innovation internally. And they were looking for externally for startups to partner with to solve some of these problems. So we really saw that there's kind of a vacuum in the market for that early stage capital that can help these companies that, when they scale, can really be transformational for the industry. So I think you can move on to the next slide, maybe. So this is just kind of overviews what some of the, I don't want to spend too much time on this, but kind of the massive problems are in the apparel industry. And as an impact fund, I think the point that I kind of want to get across here is, as an impact fund, we really are looking at those inflection points across the industry that need change. So if you can advance to the next slide, maybe. Actually, could you go to the next one after this? Sorry.
Sure.
Yeah, thank you. So we kind of break down this whole ecosystem into production, distribution, and end of life and circular recovery. So again, kind of getting back into what we look at and invest in, it would be a new material science company that makes biodegradable polyester, so that there isn't microfiber shedding of fleece into polar fleece jackets and things like that into the water. It can break down This is a big problem that everyone's sort of latching onto with the ocean plastics issue. It's not just the plastics that you see floating around, it's also beneath the water. We're also thinking about software that can enable on-demand manufacturing, because in a lot of industries, there's been a digital backbone that's enabled kind of data management and understanding that helps enable production. But in the apparel industry, that hasn't happened so much. And there's a need for designers to communicate with their manufacturers. So figuring out how to build that digital backbone so that you can actually communicate more efficiently and more effectively means an enabling tool for reduction of waste. And then we think about kind of when we end of life and circular recovery. Most of the clothing nowadays either is sold on secondary markets outside of the United States and developing countries. Many of those countries are now refusing to take that clothing anymore. It's led to massive problems on the ground and their local markets and manufacturing for textiles, and all of that is going to be here in the US now. So we need to figure out a way to deal with that so that you can get value out of this textile waste and it's not just going to landfills. So finding these different startups and solutions that alleviate these problems when they scale can be massively impactful. So maybe, and the way that we think about impact is really looking at solutions that with every dollar of sales, they actually have some sort of positive social or environmental impact purely on the basis of the business that they're doing. So I think you can advance to the next slide. And you can go to the one after this now, I think. So we, the way that we kind of source these deals is working through a variety of accelerator programs and incubator programs. Some of these have a focus on female and diverse founders. Some do not and are more industry focused. I think as an industry focused fund, for us to both have an industry focus and purely only invest in female and diverse founders would not necessarily be in the best interest of our limited partners, since we are a fully return seeking fund. If we were sector agnostic, I think using that as your primary filter and driver and theory of change is a wonderful idea. For us, what we're committing to, and I think you can sort of shift to the next slide after this. Can you go one more, please? Oh, wait, there was, I thought I had one in here that talked about how we source and what our pipeline looks like, but I think
you don't need a slide, Leslie.
Yeah, no, I'm going to talk to that. So we launched our fund about a year ago. We haven't started investing yet, but we have started really talking to a lot of entrepreneurs. So we have about 75 companies that we've talked to over the last year, and over 50% of those companies have leadership that's either female or minority led or both. So it's something that we're very focused on and sourcing, and in our investment decision-making process, we're very focused on eliminating any sort of implicit bias that we may have. And both my partner and I, as you can see, are females, and it's something that's been very important to us the entire time that we've been building this. And one of the things that we see in this specific industry is it is fairly heavy on female founders. And there is a tendency for kind of male-driven venture capital to shy away from the apparel industry. Because, and this is kind of a high level, but there's a tendency for them not to understand the intricacies. They think, oh, this is something that's kind of a floofy women's thing. In reality, it's an extremely complex industry. But it has tended, to be, there's a heavier share of women who are starting companies to really find solutions to the problems in the industry. So what we're looking to do is be a translator for these companies, for bigger, other kind of more established venture capital funds that also look at these types of systems change and industry 4.0 type approaches, to help them understand the apparel industry better through our experience and through our relationships with these big existing apparel brands, and really help them kind of unlock seeing where the opportunity is there and understanding the specific industry and market. So the goal in that is that more capital will flow to innovation in this space, and in turn also, because of our focus on female and diverse founders, those founders will also receive greater capital flow. So I think that's kind of a high-level overview of what we're doing at Alante, and can
that's wonderful, Leslie. Thank you for that overview, and I'm sure we'll dig a little deeper through the preliminary introductions. With those two great introductions out of the way, I want to now turn it over to our resident entrepreneur panelists. And Sandia, I'm not sure if you know, but I head up the sponsorship of Thai Scale Up, which is a wonderful incubator accelerator here in the Boston, Cambridge area. And I know Solstice is a proud alumna of Thai Scale Up, coming out of the program recently. And so I would love it if you could now give a bit of an introduction to yourself and Solstice. And once you've provided that introduction, we'll get into a little bit of the dialogue and conversation here.
Great. Thank you, Scott and Katerina. Great to be here. So as Scott mentioned, my name is Sandhya Murali, co-founder of Solstice. We are working to expand access to clean energy to every American, anyone who's really locked out of the residential rooftop solar market. So if you could go to the next slide, please. Great. So the problem that we're really addressing is this one of access. So about 77% of American households are locked out of the rooftop solar market for a variety of reasons. Either they live in an apartment or a condo and therefore don't own their own roof. They may have too many trees covering their roof or other structural issues, or they don't have the right financial profile to be able to buy a system outright, enter into a financing arrangement, lease a system. And so for that reason, and almost 4 out of 5 Americans can't actually go solar. Slide, please. Fortunately, there's a solution. The new model for residential solar called community shared solar. And under this model, individual households can sign up for a portion of a large-scale solar array, like the one you see pictured here. The power from these large-scale projects gets sent back to the grid, and the individuals who are participating see a credit show up on their utility bill each and every month. And so you can think of it like a community garden, but for clean energy. So there's no upfront cost, no rooftop installation required, and households get to support local clean energy and save money on their electricity bill at the same time. Next slide, please. The community solar market is only about 4 years old, but it has been doubling in each of the last 4 years in terms of installed capacity. And the Department of Energy predicts this will be a $16 billion market by 2020, and Green Tech Media, which is a leading clean energy research firm, predicts it could reach on the low end about $80 billion by 2030. When we look at our portion of that pie, which is really everything related to getting customers signed up for these projects, so all the customer acquisition and ongoing management, we see our market size as $2 billion in 2020 and up to $10 billion in 2030. Next slide, please. So to give you a little bit more context of where we really sit in this model, we can think of this as a two-sided marketplace, and Solstice is in the center. So on the one side, you've got solar project developers, those solar companies that are experts at building and financing these projects, but they don't really have the interest or the capacity to go out and find a couple hundred households to sign up for each of these projects, or have the internal resources to be able to manage them, manage those subscriptions over the course of the lifetime of their participation. And so they pay us fees to go out and acquire these households and manage them for the long term. On the other side, you have households that can't do rooftop solar, want to participate in the clean energy economy, but aren't really aware of their options. And so for them, we provide a resource and a way to connect to community solar projects in their area. And we undertake that customer acquisition through a variety of different channels. We focus on, we do a lot of community-based organizing. partnering with local organizations, houses of worship, even larger corporates as channel partners. And we also have a robust digital and direct marketing set of activities. And we kind of tailor our acquisition approach based on where we're working, the geography, the timeline, and sort of the demographics of that area. If you go to the next slide, please. This just gives you a snapshot of where we're working. So we've worked on about 17 projects, mostly in Massachusetts, or based here in Boston, mostly in Massachusetts. And the last year, we've been spending a lot more time in New York as that market has grown. And we've generated over 70 megawatts of demand for community solar. And in terms of our customers and partners, we are partnered with nearly all of the leading community solar developers across the country. So we're focused on the Northeast right now, but we'll be kicking off activities in California in the next year, in New York City, with the New York City Affordable Housing Authority, and then also looking at a couple other states, including Illinois, Rhode Island, and New Jersey. If you go to the next slide, please. So just wanted to touch on a couple other topics, including funding and kind of our approach to hiring. So on the funding side, we've been really fortunate to receive support from all of these wonderful investors. Started off with some funding from MIT and Princeton, where Steph and I are both alums of, and as well as various business plan competitions. Our first round of funding was really from friends and family and high net worth individuals. And then as we kind of closed our angel round, we received some funding from Dorm Room Fund, which is first round capital student run venture fund, Obvious Ventures, which focuses on impactful companies. And we obtained that funding through another competition. Pipeline Angels invest in women and non-binary social entrepreneurs. Techstars, which I'm sure many of you have heard of, is a seed stage accelerator that's focused on tech startups. And then Mass VC, which is clean energy focused. And we're actually raising a round right now. And again, similarly focusing the clean tech space, in the impact space, and then a few additional angel groups as well. Next slide, please. So this is a snapshot of our team, which is constantly growing. This is at our offsite over the summer. And we really place a big emphasis on making sure we're being intentional about how we recruit staff. We want to make sure our team is reflective of the people that we're serving, and that we're kind of bringing that diversity in at all aspects of the recruiting funnel. And it's certainly challenging, but we're fortunate to have folks on the team who are dedicated to making sure that, we're not just recruiting within our own networks, but really expanding the pool of people that we can bring in to do this work. Because we are very strong believers that first opinions and viewpoints and backgrounds just make for a stronger team and really help us serve our customers better. So that's a quick overview of us. I guess we'll turn it back to you, Scott.
Terrific. Thank you, Sandhya. That was an excellent introduction to you and the team. So with those introductions out of the way, with the next 20 minutes or so, let's dig into some of the interesting issues that are relevant to both diversity and impact investing. And maybe my first topic of conversation, I'll open up to our VC panelists. And what I'm interested in hearing about is whether there are impediments for venture capitalists that really want to have a impact investing focus or a real tried and true focus on diversity when it comes to selecting their portfolio companies, whether there are really institutional impediments for VCs to go forward on that path. So traditionally when we think of venture capital, right, there's kind of three parties that are relevant. You've got the limited partners, the investors that are actually investing in your funds, which is the capital that you then as the general partners are going to take and make strategic investment decisions of how to deploy that capital. And then of course you have portfolio companies which could have a social or impact mission and or a diverse a diverse team. So maybe I'll ask Julianne first. Your focus is on investments in companies that are led by innovative entrepreneurs, many of whom are of color and women, and presumably are often overlooked by mainstream investors. Presumably you reject the false choice between investments with financial value and investments with social value. You're convinced that you can bring both returns for your shareholders and benefits for stakeholders more generally. Do your limited partners accept this premise? Can you talk a little bit about whether you've had problems or difficulties in getting the people that you raise money from to buy into the fact that it's not either or, we can do both. We can both find companies that are going to generate very handsome returns for you as our limited partners, while at the same time also promoting diverse workplaces and impact investing?
Sure. So there were probably, I don't know, maybe 7 or 8 questions in that question. So let me try to boil my answer down.
That's one of my fortes. That's one of my fortes. Yes.
So first of all, I want to acknowledge that when we talk about impact investing is an umbrella term, and you touched on this in your introductory comments, that increasingly is the way many investors want to think about the entirety of their investments. So that ranges from wholly concessionary capacity building investments in which they don't expect to make a return or expect a very, very small return, to market competitive returns across classes, across categories, across instruments, across geographies, you name it. In our particular impact investing approach, which Ed pioneered with his former fund, and which in that fund returned 32% IRR while meeting or exceeding all of its impact objectives, which was, top performance among its vintage. We see return and impact as being inextricably related, because again, our impact objective and our theory of change is all about breaking the persistent asymmetry in access to capital for talented founders who are overlooked. And we see that as a very compelling investment opportunity, not only from Ed's successful track record, but also from the profusion of opportunity we encounter. To your question about LPs, I really believe that venture investment patterns, in terms of selection and that dreaded phrase pattern recognition, are not going to change unless or until LPs move money differently. Because as long as venture funds are able to raise successively larger funds from LPs who don't make any demands on them to expand or alter their approach in any way, there's no impetus, there's no incentive, and there's no consequence to continuing in the pattern they have. And regarding raising capital from LPs, the flip side is also true. I will say that many LPs have a very difficult time engaging this question that I framed at the beginning of our conversation of, do you believe that we have a well-functioning, rational market that in fact appropriately prices opportunity and risk? And that's a really challenging question for LPs to answer, because in many cases they have been making what they consider to be prudent, unbiased, responsible, ethical investment decisions, and they perceive their peers to be doing the same thing. And yet what we see is this severe asymmetry, and that's a really difficult question to engage, right? Because it poses questions about all of us and our individual and collective complicity in achieving those really inequitable rates of capital usage. And so I will say that certainly the LPs who are investing in our fund have said, well, yes, we do see that there is a tremendous untapped opportunity, and we do see that there's a compelling investment proposition here. But that's, again, that's a really challenging conversation for a lot of people.
Right. And so, Leslie, I'd be interested to get an opinion on the same question. And I guess I'll frame it a bit differently and say for Alante Capital, your fund is a bit more, shall I say, focused than Reinventure, in the sense that you really invest in innovative companies that are specifically focused on, radically improving environmental or social sustainability within the textile and apparel industry. So a little more focused from an industry perspective, a bit of a more focus in terms of the companies you're interested in investing in. When you're reviewing pitch presentations and considering investing capital, I'm imagining that there must be some sort of matrix, for lack of a better word, where you're both analyzing the potential financial return of your investment and also analyzing the social impact of the investment.
Yep.
What sort of give and take is there between the two? In other words, does one typically overweight the other? Does it have to be kind of almost a 50-50 distribution in between the two in terms of importance to you making ultimately the investment decision, or is it more nuanced and a blend?
So I think it's the short answer is it's more nuanced, but in the longer sort of version is, I personally believe that there should be, for an individual who is making an impact, making impact investments, should be able to gauge those types of trade-offs. For us and for Alante, our strategy is for us to be a fully market rate return seeking fund. So the opportunities that we look at and the ones that we consider to be part of our portfolio really we have to believe that there is an intricate relationship between the scalability of the impact that company is looking to produce intentionally with what they're doing and the solution that they're providing and the financial return. So the way that we kind of think about that is we spend a lot of time looking at the industry, what the biggest problems are, because we're looking really early stage startups. We're talking kind of seed stage, Series A. So most of these companies have somewhere between like 2 employees and 15 employees. So really very small, very early. Mm-hmm. But the solutions have to be solutions that we've heard from the Gaps of the world, the H&Ms of the world, that we are having a really big problem sourcing or thinking about how the textile waste for people who buy our products, where it's going, what's happening with it. And we think that we'll do some sort of take-back program. So just talking about this is like something that they have identified as a massive problem in the industry. So we're able to quantify, okay, we're looking at the solution. It's a solution to a real problem. This company has made some sort of commitment, whether it's a purchase order or to somehow partner with one of these startups. So we can really understand what growth and what scale looks like for them. And we see enough opportunities out there that fit that sort of that equation, that we feel that we don't need to give up any impact for
not settling for one or the other. Yeah.
Exactly. So we're not settling for one or the other. But I think that there are places for, that's totally a legitimate thing to do.
Right. And I want to ask a follow-up question of our venture capital plans before I turn over to Sandhya and ask her a few questions. But I'm curious whether Reinventure and Alante, whether you typically participate in an investor syndicate with other VC funds, which is
And that was going to be another sort of thing that I was going to mention on your last question.
Right. And so, where I'm going here is, if that's the case, which is very common, right, in venture investing, have either of you run into problems with being in a syndicate with quote unquote other traditional venture capitalists who maybe don't have as enlightened a view as your two firms in terms of being able to invest in diverse teams and impact investing? Is it hard sometimes to reconcile the perspectives of the various members of the investor syndicate in those types of situations?
Go ahead.
Yeah. So I think that if they have arrived in a situation where they're looking at the company, you're at a place where, and you are sort of potentially part of the syndicate together already, then that is likely not part of the issue anymore. They've looked at the company, they believe in the fundamentals of the company, and it's something that they're interested in. I think the main issue is finding other investors to invest alongside you who don't have some sort of unconscious bias where they just unintentionally filter out things that you're looking at. Mm-hmm. So it's figuring out how to, if you're the initial kind of investor looking at one of these companies, finding other investors to be part of that syndicate, whether they agree with you on or are also interested in the diversity and female or impact side of things, or you just happen to know what that particular aspect of the company is that is very attractive for another investor to help bring in other capital that is may be completely agnostic to that. But you just have to put that first in front of them and figure out how to have that conversation from kind of a marketing perspective.
Julianne, anything you want to add to that, Julianne?
Yeah, I, first of all, I would say I agree with almost all of it, though the significant departure we make is we invest a mix of equity and debt, and we're focused on growing companies profitably. And that is a significant enough difference in practice from a lot of our peers that we don't actually find our syndicate is most often with other venture firms. We don't rule them out by any means, but we find our partners tend to be corporates and strategics more often.
Mm-hmm. Got it. Okay, interesting. I want to turn things over to Sandhya a little bit and ask her a couple of questions. Sandhya, it's very apparent we were looking through your slides and we saw that wonderful picture of the team that you and your co-founder have assembled. You clearly have a diverse team, both from a gender perspective and from an ethnicity perspective. Can you talk a little bit about whether that has been a deliberate initiative of you and your co-founder, and why, in your view, having a heterogeneous team is good for founders, and as a result of that, presumably the investors that back the companies that founders create in the first place?
Sure. So I think when we were first starting out, we were looking for people who were just generally rock stars, and you look for people in your network that are willing to join you on this crazy adventure. And so I don't think we were necessarily as intentional about it, but probably being, both of us being women and women of color, we didn't necessarily gravitate, I think, towards one particular type of person. And our networks, are going to probably be, potentially be a little bit more diverse. So in the early days, I don't think it was as, we certainly weren't as intentional about hiring. We were just trying to find the right people that could kind of come in, get their hands dirty, and were willing to sign up for this ride. And then as we've grown, we've certainly made an effort to expand the different channels we use to recruit and just make sure we are getting that diversity at the top of the funnel. And I think it's certainly important. I'd say the one thing that we look for in every one of our hires is a commitment to the work that we're doing, to the mission. Everyone really, we've kind of codified our values as a team, and everyone sort of upholds those values or believes that, these things are important. But I would say the personalities and backgrounds of everyone are very different. But that one thing that does unify us is that commitment to the mission and kind of commitment to hard work as well. So that's something, those are, of course, non-negotiables. But the diversity of opinion, of viewpoint, and really backgrounds, where people are coming from, I think has made us a stronger team. As we think about, new strategies to reach customers and new ways to kind of interact, or really it all comes down to kind of how we're interacting with our end user customers, those households that we're working to get signed up for solar. And I think being a customer-facing organization or consumer-facing organization, we need to make sure that we are meeting people where they are and kind of speaking their language. And so if all of us are kind of from the same background, coming from the same region, it's going to be much harder for us to think about how to connect with people on their level. And that's really the key to making us successful and to being able to deliver what we can deliver to our solar developer partners. The other thing I'd mention, just as it relates to acquiring customers, working with customers, is that anytime we start a new project, we do look to bring people on locally to help with that outreach work. We know that we can't take our team in Boston and kind of parachute into all of these areas. We really rely on local contractors, local, we call them ambassadors, to help us think about what are the best ways to reach people, what are the networks we should get involved in. So I think we think about our hiring strategies, we expand to new geographies on a local level too. It's not just kind of diversity the way we've traditionally defined it.
That's a great segue to that, and you started answering my next question before I even had the chance to ask it. So we're on the same wavelength. I think when we talk about diversity, sometimes that can be a generalized term, and it's important to make sure when we say diversity that we're speaking about the same thing. So certainly there's racial, cultural, gender diversity, but I think there's also diversity of thought. And so I'm wondering, and you're a great example, you and your co-founder are alumni of very prestigious name brand academic institutions. Do you feel that it's important to, as you're looking to assemble your team and build out your company, to look beyond the quote unquote usual suspects, the MITs, Harvards, Princetons of the world, and look for team members that maybe come from out of those ecosystems? Is that something that you found to be valuable and helpful as you're building the team? And if so, how do you engage those people?
Yeah, absolutely. If I look at the background of folks on our team, people come from a variety of different backgrounds, different schools. Some come from no schools. So, we've been, I think, lucky to not necessarily just pull from our networks and the fact that, we've been privileged enough to go to these amazing schools. We do have access to really good networks, but our team has, fortunately, kind of probably serendipitously come from a bunch of different areas. It's challenging to ensure it all comes down to kind of getting candidates in at the top of the funnel. Ultimately, you have to make sure they're a good fit for the role, but if you don't have those candidates to evaluate from the start, then you're going to be stuck kind of recruiting from that same pool of people. So we have spent, I think, in the last year, a lot of time figuring out how to post our job descriptions across, all different schools in the area. Doesn't really matter what schools they are, because good candidates can come from anywhere. They just need to know about us, and they need to know these positions exist. So we've definitely invested a lot of time on kind of the top of the funnel and putting these JDs out there, and hoping that we get in a broad group of candidates so that we ultimately, we're not screening just on the basis of that background, but really based on the fit for the role and the skill sets required for the role.
Right.
But it is challenging.
Yeah. Yeah. Thank you for sharing that. Yeah, I think that's words definitely ring true. I'm wondering if the venture capital panelists might be willing to pull the curtain back a little bit and talk about the typical fundraising process as they're considering investment opportunities. And what I mean by that is oftentimes when I'm counseling clients of mine that are entrepreneurs interested in raising capital from venture capital funds, they don't really have an appreciation for the sales funnel, if you will, for venture capital funds. And by that, I mean how many initial inquiries or business plans you'll see at the top of the funnel and how many in-person meetings or pitches that leads to, and ultimately how many term sheets and investments that results in. And I think that would be very helpful if Julianne and Leslie, you wouldn't mind sharing that, to talk a little bit about, if you could, and you'll probably have to generalize from your historical experience. Can you give a sense for the audience of, again, from the top on an annual basis, how many opportunities you're looking to, and what does that translate into in terms of real in-person meetings to, an investment opportunity taken to committee, to a term sheet, to actually allocating dollars to an opportunity? And Julianne, if you wouldn't mind, I'd love it if you could bat first and give some insight to that question.
Sure. So our approach, again, is really atypical in the way that we go about our investment. But I would say what's representative, and what I also talk to founders a lot about, is understanding that a particular firm only does a relatively small number of deals per year. And that number varies, of course, by firm. But in our case, it's 3 or 4.
Mm-hmm.
And so just to understand that is an important thing for founders. Our approach is quite different. We actually don't like to field pitches and queries. To your point about going out and finding talent, we really like to identify teams who are upstream of an investment decision from us. So as I mentioned, we focus at that break even or so. We will meet teams when they're at first revenues or even before that, who we think have the potential to be candidates for our portfolio. We meet them through our network. We meet them through those seed and pre-seed stage allies of ours. We meet them by going specifically to events like Black and Brown Founders and Zebra convenings and Black Tech Week and the like. And we find a way to be helpful to them based on whatever they're struggling with at the time. So we have already helped founders in a variety of ways by introducing them to seed stage investors or customers, or helping them to understand term sheets they've received so they can negotiate on an informed basis. And we don't tell them what to negotiate or what they should want, but just so they understand the terms. We have helped them to clean up their financials. We've helped them to clarify their customer pitch or their investor pitch or a variety of other things. And that gives us an opportunity in a very short engagement with them, an hour to a few hours, to get a very clear sense of the team and how they interact with one another and how they deal with surprises and setbacks and new information, and whether we believe the business is what they believe it is. And that starts a relationship. And so we engage with anywhere between 30 and 50 teams at that level in a given year of actually paying attention and checking back with them a couple times over the course of the year. And as I said, we will only do 3 or 4 deals. So one of the reasons that we engage that way is because we believe, first of all, that gives us a much stronger basis on which to make an investment decision when we get to that point. It also establishes a relationship that's based on trust. And furthermore, again, it gives us a very, very intimate view into the team and the way they operate. which enables us to make a really well-informed assessment. And we leave all the teams we engage with better than we found them, which is, again, important to our investment approach and our theory of change.
Got it. Okay. Thank you for sharing that. Leslie, would you be willing to share your impressions for the same question?
Sure, absolutely. So, I mean, for us, we are a new fund and have only been sort of starting to develop pipeline over the last year.
Right.
We've sort of, and this is just a high-level overview, probably gotten pitches from 100 companies. We've probably had 75 first conversations, and then filtered things down. You know, like Julianne will invest in 3 to 4 companies a year. And so they're kind of those 75, maybe 5 will do deeper diligence on to invest in 3 or 4 of them. But similarly to what Julianne was saying, we're kind of focused on Series A, which is quite a bit earlier than Julianne. But at the same time, we also want to get to know these founders when they're more at their seed stage, and be helpful where we can, watch them grow, understand kind of with them while they're growing what the opportunity they're looking at is, and see where we can be helpful. But to Julianne's point, it's just very helpful when you get to the position where you can actually make an investment. You've already known them for a year. You already have a feeling for who the founders are. So, you know, for those of you on the phone who are founders, developing those relationships early can be really worthwhile. Even if you aren't going to get an immediate check from it, you'll possibly get a lot of other very valuable things, and probably an introduction to other earlier stage investors as well.
Yeah, I couldn't agree with you more on your last comment there, Leslie. That definitely rings true to me. We're, believe it or not, already through the full hour. I'm smiling with Katerina here because I'm looking down at my list of questions that I was hoping to ask, and I got through about 10% of them. This is such an interesting, as I said earlier, area and topic of discussion that we could probably have a 3-hour conversation and not even get through all the questions. We've actually, as we've been sitting here, receiving a bunch of questions from the audience, but believe it or not, virtually all of them have been, they've been very complimentary and asking if we can forward the slides from the presentations because they'd like to take them with them so that they can refer to them after the fact. And so, Katerina, I think we'll be more than happy to do that. If people want to follow up, we'll be happy to provide the slides. And as I said, we're out of time. I want to thank our panelists for taking time out of their busy schedules to be with us here today, to share their stories and their views on these important topics that we've been discussing. I certainly have enjoyed the conversation. I hope everyone else did also. Katerina, is there any kind of parting comments that you'd like to leave us with today?
Thank you, Scott. I believe that I would like to say just thank you to everyone, to you for moderating the panel, and all the panelists for this fantastic conversation. Thank you as well to all of you that joined us today. We hope this was a valuable session. And again, to our sponsors, MACC, NYSERDA, Commercerai, Rhode Island Foundation, National Grid, and Roy A. Hunt Foundation. So by early next week, we'll send everyone the recording of the webinar, along with the slides and the short survey. So we appreciate very much your feedback and support. We hope you all in our future webinars. As you can see, we'll have 2 in December, 6 and 13. So again, thank you very much. Have a great day and weekend too.